Are penny stocks really the jackpot you've been looking for? Or are higher price stocks the secret to building long-term wealth? The answer might surprise you. Let's break it all down so you can make smarter investment decisions.
Hi.
In today's video, we're going to explore whether you should focus on penny stocks, higher price stocks, or stick to a specific price range for better investment opportunities. Are price tags the key to great returns, or is there something more to it? Thank you for watching, and please subscribe to my channel, TheFinanceSavvy, for more updates and insights. If you have any questions, feel free to reach out. Let's dive into the video. 1. Penny stocks, the pros and cons. Let's start with the allure of penny stocks, those ultra-cheap shares priced under $5. For some, they're like a lottery ticket, cheap to buy but promising massive returns if they hit the jackpot. The good. Here's the appeal. Penny stocks allow you to own thousands of shares for a fraction of the cost. If one of them skyrockets, you could double or even triple your investment overnight. They're often linked to small companies with big dreams, which can be exciting. The bad, but here's the harsh truth. Most penny stocks are cheap for a reason. They're often tied to companies with weak fundamentals, high volatility, and limited track records. Some even fall into the infamous pump and dump schemes. It's a high-risk, high-reward game, and most investors lose. Perspective. While I've seen people chase penny stocks and succeed, I've also seen many who've lost big. My advice? If you're dabbling in penny stocks, treat it like gambling money. Never invest more than you're willing to lose. 2. Higher price stocks. Are they worth it? Now, let's talk about the other end of the spectrum. Higher price stocks, like those $100, $300, or even $1,000 per share companies. Think Apple, Tesla, or Amazon. The good, higher price stocks often represent established companies with strong track records, consistent growth, and predictable revenues. These companies are usually industry leaders with competitive advantages, less risky, more reliable. The bad, but higher prices don't always guarantee safety. Sometimes even high-priced stocks can be overvalued. And let's face it, not everyone has the budget to buy a $1,000 share of Amazon or even $300 for Tesla. Perspective. In my experience, higher-priced stocks are like the luxury cars of the stock market. They come with premium stability, but you need to make sure you're not overpaying for the brand name. 3. Finding the sweet spot. Price range versus value. So, where does that leave us? Is there a golden price range for stocks? The truth is, the price of a stock doesn't matter as much as its value. Story time. Let me share a quick story. Back in the day, I watched a $100 stock double its value, while a $2 penny stock tanked to 10 cents.
Why?
The $100 stock was backed by solid fundamentals, strong earnings, growing revenues, and a competitive advantage. Meanwhile, the penny stock was all hype and no substance. What matters? Instead of focusing on price, look at metrics like the company's price-to-earnings ratio, PE, revenue growth, debt levels, and industry trends. A $5 stock with strong fundamentals could outperform a $500 stock in the long run, and vice versa. 4. Risks and rewards. Balancing your portfolio. The key to success is finding balance. Here's a simple framework to help guide your investment strategy. Diversify. Mix lower-priced stocks, mid-range stocks, and higher-priced ones in your portfolio. Don't put all your eggs in one basket. Do your research. Focus on companies with strong fundamentals. Whether it's a penny stock or a $1,000 share, what matters is the company's ability to grow and generate profits. Know your risk tolerance. Are you comfortable with high volatility? Or do you prefer safer, steady investments? Let your risk appetite guide you. Remember, the goal is to grow your wealth, not chase quick wins or take unnecessary risks. Closing thoughts. So, should you choose penny stocks, higher price stocks, or a specific price range? The answer depends on your investment goals, risk tolerance, and research. Penny stocks might offer quick thrills, but higher-priced stocks bring stability. And if you can find great companies at fair prices, no matter the cost, you're on the right track. Also, while we're on the subject of should you buy penny stocks or higher-priced stocks, the truth about stock prices, let's continue with the following stocks. But first, Ever wonder how to pick the perfect mix of stocks for your portfolio? Whether you crave stability or are ready to take on big risks for even bigger rewards, today we're breaking down 6 stocks that could transform your investment game.
Hi.
In today's video, we're going to explore 6 intriguing stocks: ERIS, AROC, CEG, GSHD, MNPR, and QMCO. From stable long-term investments to high-risk, high-reward opportunities, we'll cover what makes these companies unique and how they could fit into your portfolio. Thank you for watching, and please subscribe to my channel, TheFinanceSavvy, for more updates and insights. If you have any questions, feel free to reach out. Let's dive into the video. 1. Stability first, stocks for risk-averse investors. If you're someone who values stability and prefers steady, reliable growth, let's start with 3 stocks that operate in industries with consistent demand: CEG, Constellation Energy; AROC, Archrock; and GSHD, Goosehead Insurance. Constellation Energy, CEG. CEG operates in the energy sector, providing clean, reliable electricity, an essential service we all rely on. With the increasing push for renewable energy, Constellation Energy has positioned itself as a leader in the transition to cleaner power sources. For long-term investors, this makes CEG a strong contender for stable returns and a hedge against economic uncertainty. Archrock, AROC. Archrock provides natural gas compression services, which are essential for transporting and storing natural gas. While natural gas isn't as flashy as clean energy, it remains a key part of the global energy landscape. Archrock's steady demand makes it a lower-risk option with a healthy dividend yield for those who value income generation. Goosehead Insurance, GSHD. Now, let's talk about Goosehead Insurance, a company shaking up the insurance industry. Goosehead operates a unique franchise model that prioritizes customer experience, setting it apart in a highly competitive market. As insurance is a necessity in every economy, GSHD offers both growth potential and stability for investors looking to balance their portfolios. 2. High-risk, high-reward stocks for aggressive investors. Now, if you're feeling adventurous and want to take on some higher risks for potentially higher rewards, these 3 stocks, MNPR, QMCO, and ERIS Water Solutions, might catch your attention. Monopar Therapeutics, MNPR. MNPR is a biotech company focused on innovative cancer therapies. Biotech stocks like MNPR are inherently high-risk, given their reliance on FDA approvals and successful clinical trials. However, if Monopar achieves breakthroughs with its drug pipeline, the potential rewards could be massive. It's a stock for those who can stomach volatility in exchange for big upside potential. Quantum Corporation, QMCO. Quantum specializes in data storage and management solutions, a critical area in today's data-driven world. While the company has faced some challenges in recent years, its focus on modernizing and expanding into edge computing and video surveillance markets could fuel a significant turnaround. Keep in mind, though, that it's a work in progress, so patience is key with QMCO. ERIS Water Solutions, ERIS. Finally, ERIS Water Solutions is tackling one of the biggest challenges in energy production: water management. By providing sustainable water recycling solutions for the oil and gas industry, ERIS aligns with growing environmental concerns. While it's riskier due to its ties to the volatile energy market, its innovative solutions could lead to long-term rewards if the sector continues to adopt sustainable practices. 3. Balancing risks and rewards. Here's the million-dollar question: should you stick with stable stocks like CEG and GSHD, or take a chance on high-growth opportunities like MNPR or QMCO? My advice: diversify. A balanced portfolio that includes both stable, dividend-paying stocks and a few high-risk growth stocks can help you achieve steady returns while still having a shot at explosive gains. Pro tip: always research the fundamentals, like revenue growth, debt levels, and competitive advantages, before making your decision. And don't forget to consider your risk tolerance. The goal is to invest in what feels right for you. Conclusion: for risk-averse investors seeking stability, companies like Constellation Energy Corporation, CEG, Archrock Incorporated, AROC, and Goosehead Insurance Incorporated, GSHD, may be suitable due to their operations in industries with steady demand. Conversely, those comfortable with higher risks for the possibility of higher rewards might consider Monopar Therapeutics Incorporated, MNPR, Quantum Corporation, QMCO, or Aris Water Solutions, ARIS, as part of a more aggressive investment strategy. Please note that stock prices and financial data are as of January 17, 2025, and are subject to change. Always conduct thorough research or consult a financial advisor before making investment decisions. Again, thanks for watching. If you found this video helpful, don't forget to like, share, and subscribe to The Finance Savvy for more insights. Got questions? Feel free to reach out. We'd be happy to help. Until next time, happy investing.